Okay, so thank you very much. And let's remain muted. The class is going to start now. You're welcome again to Equity Professionals. Our class today is on financial reporting, and this class is a combination of my physical class and my virtual class. So, and my virtual class are already ahead of the physical classes. So ultimately, I'll be starting from where I stopped from those behind, which is chapter 2 of the conceptual framework. And we're going to meet up ultimately. So remember that for my part, I started financial reporting with an introduction to regulatory framework, where I explained to you that this deals with the regulations that governs reporting, as well as the regulatory bodies that develops these regulation. The regulation were the GAP, which is the National Accounting Standards, the National Company Law, and the local stock exchange listing requirements. But we said for financial reporting, our focus is going to be on the National Accounting Standard. And we also narrowed down the National Accounting Standard to IFRS or IAS. And in Nigeria, the regulatory body in charge of IFRS is the Financial Reporting Council of Nigeria. They are the one in charge of IFRS. So we discussed all of that. And I also told you that as far as IFRS is concerned, there is an international body that is responsible, that actually develops this standard, which we looked at a complete structure from the monitoring board to from the monitoring board to the IFRS Foundation to the standard setting bodies. We looked at those three-tier structure and we explained it critically. That was regulatory framework. Then conceptual framework. I told you that the similitude to a conceptual framework is the way a house is to an architectural plan, right? Or a blueprint of a house. So the relationship between the blueprint of a house and the house itself, and is the same thing as relationship between the conceptual framework and the IFRS. You see, the blueprint of a house gives the house a structure. What is on that paper is exactly how the house is going to come out, right? The same thing for conceptual framework. It gives the development of accounting standard or IFRS, it gives it a structure. It makes it coherent, right? In such a way that almost all IFRS being developed now has a similar structure. Is because they are developed from a single basis, which is the conceptual framework. So we discussed all of this introduction in our last class. Ultimately, we went on to the content of the conceptual framework. We went on to the content of the conceptual framework, and we said that these contents are arranged in chapters, and there are 8 chapters. So we looked at chapter 1 that talks about the objective of a general purpose financial report. And we mentioned that this objective of a financial report is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. I told you that The first thing that captivated my attention in this objective is the fact that they have specified the users to which we are providing the financial information. And these users are potential and existing investors, lenders, and other creditors. That does not undermine or mean that there are no other users of financial report. I explained that, but these are the key people. And the reason why they are so important to us right now is because they are the ones that are providing the resources. And I told you that the information that these users make is peculiar to each of them. The investor, for example, now, I told you they would want to use this information to make decision about whether to sell their shares or whether to buy more shares. I mean, whether they should invest more in the company. Additionally, the investor will also want to make decision on how to vote during whether AGM or maybe extraordinary meeting, any meeting, and it requires that they should vote. I mean, they would need financial information so that they can vote appropriately. Another one is the lenders. I told you that the lenders need this information so that they will decide whether or make decision whether they should provide additional loans to the entity or whether they need to find every possible way to recover the existing loans. And finally is other creditors. So other creditors will make decision about whether they should provide trade credits to the company or not. And the final thing here is the financial information being provided. I told you that the financial information being provided are assets, liabilities, income, and expenses, which we presented as economic resource of the entity, the claims against the resource or against the entity, and changes in the entity's economic resources and claims. These economic resources is what I described as assets. These claims is what we described as liabilities. These changes in the entity's economic resources and claims is majorly returns or profit, but we can break it down into income and expenses. And finally, I told you that this financial information are prepared on an accrual basis. Accrual basis in the sense that you recognize income when they are earned and not when money is received. And you recognize expenses when they are incurred and not when cash is paid. Okay, so okay, yeah. So those were what we discussed in the last class. Somebody said my voice is low. Is it just Ogechi or is it everybody?
I think it's fine.
I think it's all right.
Okay, so Ogechi, increase the volume of your device so that you can hear me properly. Okay, so like I mentioned, we're going to start from chapter 2. So it's a good revision for my virtual class. So just follow along. So chapter 2 talks about qualitative characteristics of useful financial information. So the qualitative characteristics is what makes the financial information useful to users. Is what makes the financial information useful to users. In the sense that without these qualitative characteristics, the information might not be useful, right? And the conceptual framework distinguishes between fundamental and enhancing qualitative characteristics, meaning that there are two qualitative characteristics. There is the fundamental and there is the enhancing. The fundamental qualitative characteristics distinguish useful financial information from information that is
Chris,
not
I think you are
useful.
too fast.
Okay. I'm okay. I don't know. Am I too fast? Please answer me. Am I too fast? So I can know how I want to.
Better now, just please slow down a little bit.
Yes, you
I
are
think
too
you're good,
fast, sir.
sir, but is this course recorded, please?
Of course.
So I
All the
think
plans were recorded.
So since it's
Okay.
recorded, you can always go back to listen to it.
Yes. And again, I'm not dictating, if that's what you mean by I'm too fast. I hope you are not planning to write everything I'm saying.
Not
You can
really.
always jot.
Just slow down. That's what I mean.
Yes, you are not writing. Just
Oh, okay, good.
want to follow you.
All right, good. So again, the fundamental characteristics is what make the financial statement or the financial information either useful or not useful, right? So which means that if a financial information does not have these fundamental qualitative characteristics, it is not useful. If it has it, that means it is useful. That's the fundamental qualitative characteristics. But the enhancing qualitative characteristics distinguish more useful information from less useful information, meaning that this qualitative characteristics is what makes the information or the financial information more useful or less useful. So it makes it more useful or less useful. But the fundamental, that one is what makes it useful. If a financial information lacks the fundamental qualitative characteristics, then it is not useful. So let's start with the fundamental. There are two fundamental qualitative characteristics. There are two of them. Number one is relevance, and number two is faithful representation. So the first one, relevance. What do we mean by when we say financial information is relevant? Is relevant if it is capable of making a difference in the decision made by users. So anything at all that helps you make decision, of course, is relevant to you. But bringing it to financial reporting, when we say an information is capable of making a difference, I mean, looking at it literally, it means that it assists you to make a decision. But here, what capable of making a difference means is that that information must have predictive value and also must have confirmatory value, or both, either predictive value or confirmatory value. So predictive value, as the name implies, we should be able to use that information to make predictions. Confirmatory value in the sense that all your past predictions, these current reports must be able to confirm it. And for confirmatory value, the only way this current information can help you confirm your past predictions is if the information are presented in a way that is consistent, is comparable. So then it will help with confirmatory value. Then the key question is this. I mean, when they say it is capable of making a difference, if it has predictive value and confirmatory value, Confirmatory value is quite very clear that, okay, maybe we made a prediction in the past. Maybe in 2020, we said, this company by 2023, they should be able to do maybe 10 million in revenue. Now in 2023, we can see whether they made that 10 million or not. We can see. And of course, they must be consistent, or they must present that information in a way that is actually comparable, right? But how can the financial information have predictive value? How can it have predictive value, right? So I've taught this thing before to my virtual class students. So let me see if you still remember what we mentioned, right? Because when you look at a financial information, like for example now, you present your income and expenses in your statement of profit or loss. And don't forget, what we present in our books are historical transactions, the money we have spent, money that people have spent, or the money we have made, right? So how do you think that can have predictive value? And I need ideas. So you can unmute if you have any opinion.
Hello, sir.
Yeah, I'm with
Hello.
you.
Yeah, I
Yes,
think you said by comparing it to the previous year balance.
that's correct. That's one of it. Yes. So if you look at the way statements are presented, IS1 requires that for if you present these current year figures, you must give us comparative information of the previous period. So by the time we are in 2024, you present your books, your figures for 2024. For example, now you said your revenue in 2024 is 5 million. And I'm able to see that your revenue for 2023 is 4 million. I'm able to see that. Then I can easily say that, okay, this revenue is going up. Then I can predict that it will continue to grow. Of course, it's just an estimate, not like I'm sure, it's a prediction, right? So by providing comparative information, reports can have predictive value. Yes, sure, you're correct. Comparative information. Any other one? Another one is by presenting one-off material items separately on the face of the account. One-off material items by providing them separately on the face of the account. It makes the report have predictive value. What do I mean? So items like a profit or loss on disposal of an asset, for example, now. Maybe you sold an asset, you now made a huge loss or a huge profit. Don't lump that kind of loss or profits along with other expenses or other income. Present it separately so that whoever is looking at your figures would know that, this one is a one-off item. You should not be expecting that kind of profit or huge loss next year. This one, we just sold an asset this year, an asset ordinarily that we were using. We just said, okay, we don't need it again. Let's sell it, which was why this actually came. And a lot of one-off transactions like that, they have to be disclosed and presented in the books separately. That will also make the information have predictive value. Another one is if you want to discontinue a segment of your business or a branch of your business, IFRS 5, a standard that you are still going to learn, will tell you that you have to present that discontinued operation, present his income expenses separately from the ones you want to continue. Let people see that, okay, this is the one you want to discontinue, because it makes people know and aware that something is coming up. This guy would, and by the time they see the performance of that discontinued branch or operation, then they will understand why you want to discontinue it, right? That's another one. Presenting discontinued operations separately. You are going to learn that. All of these things I'm saying, you are still going to learn all of them. I'm just trying to make you understand how an historical information can have predictive value. Another one is, if you want to sell an asset, you intend to sell it. You have not sold it, but you intend to sell it, right? IFRS 5 will tell you that that asset you want to sell, present it separately and call it non-current asset held for sale. Present it separately and call it non-current asset so that people would know and see that, okay, this guy is planning to sell some of his assets. Another one is IS 33, which Mr. Kazim and Mr. Ibrahim, depending on which class you are, will teach you about earnings per share. Earnings per share, there's something we call diluted earnings per share, which will consider the effects of potential ordinary shares on our earnings, meaning that if all of the people we have promised shares in the future, all of the people we have promised shares in the future, if they become ordinary shares today, I mean, if we issue them all of these shares today, what impact will it be on our earnings? Presenting dilutive or diluted earnings per share, it's also making the information have predictive value. I can go on and on, but as you continue to learn, you would learn all of these things I've mentioned. But yes, all of these things make the financial information have predictive value. Predictive value. And I give an example of GSK. They left early this year. And if you had been reading their financial report as far back as 2016, I mean, a user will have known that these people are living. It's clear because their financial information, it was there. This discontinued operation was there. Non-current asset held for sale was there. The number of staffs decreased from almost 500 down to less than 100 within 1 year. So all of these things, if someone that has read their books will know that, oh, this company is actually leaving Nigeria. So it wouldn't have been a shock to the market. I mean, that much of a shock to the market when they eventually disclosed to the media that, okay, now we are leaving. Okay, so that's relevance. So for us, when you're explaining relevance in the exam, is just telling the examiner that if financial information is relevant, if it's capable of making a difference, and it's capable of making a difference if it has predictive value and confirmatory value. You don't need to start giving them all these examples I've gave you. All these examples are in these notes. However, the examiner can ask it as a special question that how can an historical information have predictive value? So that's when you can start giving them all of these examples I gave you. So when we talk about relevance, you see, relevance of an information is affected by its nature and its materiality. So when we say nature and materiality to be specific, when we say an item is material, it means that if you omit that item or if you misstate that item, it will influence the decision that a user wants to make on that financial information. If you omit it or if you misstate it, it will influence the decision that user is making. So that kind of item is material. And materiality is what determines relevance. It's the determine, there's no way you can talk about relevance without talking about materiality, because it's what will ultimately determine whether your report will be relevant or not, because that is always the focus. So materiality or relevance is affected by nature and materiality of the items. That's relevance. The second one is faithful representation. So here, they said that financial reports represent economic phenomena in words and numbers. So when we talk
Hello?
about financial information,
Hello? Please, can you explain nature?
so it depends. When we talk about this, the reason why I omitted or left this one is it's very open and it's a bit related to the materiality of the item. So this materiality covers everything. But if I want to make it simple for you, then we'll be looking at whether the item is whether is an asset or whether is an expense or whether is a descriptive information or whether it's an information that has to do with quantitative. So that's nature. It depends on what item you are talking about. And so ultimately is under materiality. So this nature. So when we're talking about expense, so expense, there are some money you will spend that some entity will say, okay, this one, we are going to expense it because of the nature and the amount. But when the amount gets to a certain limit, they would say, okay, this one, we should capitalize it. Okay, so it's open, right? Which is why I just focus more on the materiality, which is what you should focus on, because you'll have taken care of the nature itself, right? So going forward, faithful representation. It says here that financial reports represent economic phenomena in words and number. So what we are saying here is that a financial information, what we are presenting is about economic activity. So the way I put it here is exactly how the conceptual framework framed it. So it represents economic activities. When you say economic phenomena, maybe their sales, their assets, their expenses, their liabilities. That is what you would find in a financial information, both in words and number. Okay, so you see, those economic phenomena, you must faithfully represent it, which means that what you are presenting, I mean, the way they put it here is that financial information must not only represent the phenomena, but must faithfully represent the phenomena that it purports to represent. And what this is saying is that what you are presenting in your books, what you are presenting in your book must represent the economic phenomena, must faithfully represent the economic phenomena, which means that if you are presenting that your sales is 100 million, let that 100 million, let it be the economic phenomena, let it be your economic activity, let it be your sales, right? Let what you are presenting, it should faithfully represent the economic phenomena. So, I mean, this part of the conceptual framework is just entrusting we professionals that we are going to do the right thing, right? It's just entrusting, okay, make sure you faithfully present what those transactions represent, right? Don't manipulate. That's what they are saying there. Okay, so he's just believing that we will do the right thing, right? Which I believe every one of us here would do. However, he now gave us a further guide. He says that, okay, for you to faithfully represent, right, then the information must be complete, it must be neutral, and the information must be free from error. So when we say complete, we are saying that the information you present to user must include all the necessary descriptions and explanation. It must include everything. Don't include everything that user needs to know about that transaction. Both the number, put it there. If it has some explanation, put it there. Tell us everything, complete. So whatever figure you put on the face of the books, there is something we call notes. Go to the notes and show us the breakdown in both in figures. The ones that require explanation, give us the explanation. So if you have on the face of your book, you have staff costs of 100,000 naira. In the notes, go and break down that staff costs, the ones that relate to salaries and wages, the one that relates to pension, the one that relates to other benefits. Explain everything to us, right? The type of pension scheme you are using, explain it to us. I mean, all of this information, put it there, but for your exam, you don't have to. Just tell the examiner that complete means that all information necessary for user to understand your economic activities are included, are being depicted, both figures, descriptions, explanations, everything should be there. Then neutral, you see, when we say neutral, it means that you are not biased, okay? So for financial reporting purposes, for you to faithfully represent, it means that you must not manipulate your figures. Don't manipulate it because you want to influence decision. So a lot of people, not a lot of people, most entities, especially those that are listed, investors are always waiting for when they issue out their reports because it has heavy impact on their share price. They might be tempted to not be neutral and be focusing on what investor would think or the impact of their figures on their share price. No, don't be biased. Don't think of influencing users' decision. Don't manipulate the figures. Neutral. Present it the way it is. That's faithful representation. Present what your economic activities represent. So don't be biased. And in order to further explain neutrality, the concept of prudence was reintroduced. Prudence was reintroduced into the conceptual framework just to further explain neutrality. And a lot of people, maybe non-accountants, they would think when we say an accountant is prudent, it means that the accountant does not spend money or maybe is not wasteful. But in this context, what we are saying here is that anytime you want to recognize figures in the books, make sure you exercise caution. Exercise caution in such a way that you are not overstating or understating your assets, your liabilities, your income, and your expenses. So exercise caution when you are making judgments under conditions of uncertainty. So, so prudence, if I want to go deeper, when it comes to income, okay, the prudence will say that be very cautious, be very slow in the record of income. And when I teach you, when we look at IFRS 15, in few weeks to come, you will see that that standard on revenue, IFRS 15, really takes into consideration the concept of prudence. Now, there are 5 steps that must be completely followed before you can recognize revenue in the books. Those 5 steps must, and there is no way that if you follow those 5 steps and you eventually recognize and measure revenue, you cannot overstate or understate it. It's unlikely. It's unlikely if you follow those steps. So those standards are just incorporating prudence. Of course, those standards are prepared using the guidance of this conceptual framework, of course. So that's prudence, ensuring that you are slow in the recognition of income. And also, don't overstate your assets. Don't overstate your asset. Don't say, my position is huge. No, don't overstate your asset, which is why when we have trade receivables, right, you're expecting to collect money from some people. The standard on financial instrument dealing with trade receivable will tell you that if this customer that you want to collect money from, if he's showing sign of distress, not even in fact, if the economic environment where that customer is operating is in distress, he will say that you should make an allowance. They call it impairment allowance. Make an allowance that a portion of these receivables might be lost. Make an estimate, right? All of this is just to ensure that, okay, don't overstate your assets. Again, when you look at most standards, like for example now, inventory, I will say that when you want to recognize inventory in the books, you should measure that inventory at the lower of costs and or net realizable value. It's just so that you do not overstate your inventory. That is prudence. And when you implement all of these things, then you are faithfully representing books and figures in your books. Okay. Someone wants to ask a question. Please go ahead.
Okay, thank you, sir. So my question is in line with the last comment you made about ensuring if there is a distress in my trade receivables, that we should mention it there by making an allowance for impairment. But since, let's say for publicly quoted companies, that these financial statements will be made known to the public, if I do that, wouldn't that be sending signal to the person I'm expecting these receivables from to renege on their own promises to pay me?
Oh, fantastic question. Fantastic question. Yes, of course, it's actually possible, especially if you now list their names on the face of the accounts, which we don't, right? So when it comes to IFRS 9, we do not impair on an item by item basis. It's usually on a portfolio by portfolio basis. So even though we are making an impairment, it cannot be pinpointed down to a singular customer. But you have made a fantastic observation. I really appreciate that. Good one. Okay, more observations like that. Okay, so that means we can move forward then. So that's neutrality. Then still on faithful representation, the last one is free from error. Free from error. So when we say free from error, before I even look at this explanation, I mean, the simple meaning might be that the figures should be accurate, right? But that is not what it means here. Free from error does not mean that the figures in your financial information should be accurate. What does free from error then means? It means that there are no errors or omission in the description of the phenomena, and there is no error made in the process by which the financial information was produced. So 2 things, right? When you are describing your transactions. When they say phenomenon, this I'm using phenomenon. That was what they used in the conceptual framework. When you are describing your transaction or events, don't omit, don't make error. Describe it in a way that users would be able to understand it, especially when you are describing your transactions. Describe your assets, your expenses, name them properly so that anybody that looks at it can easily relate, right? If it's professional fees, let us know what professional fee. Is it audit fee? Is it legal fee? Let us know. Explain all of these things. Don't omit and don't make errors. And again, in the process by which the financial information was produced also, don't omit nor make error. When we say the process, I mean the debit and credit you pass, right? The estimates you make. Don't make errors in that process. Because if you have gone to debit what you're supposed to credit, or credit what you're supposed to debit, is an error, right? And that means it's not free from error. So free from error does not mean that our figures should be accurate, but it means that don't make error when you are describing your transactions, and don't make error in the process of producing this financial information. So saying that our figures cannot be accurate, why? It's because in reporting, we make use of estimate and judgment. A lot of estimates, a lot. Like that impairment I spoke about earlier on is an estimate. I mean, I'm just estimating that this guy might not pay. He might pay. So I'm just estimating. And again, how much am I even estimating that he will not pay? It's an estimate. So there is no, we will just make estimates. When we are calculating depreciation, and we usually use useful life to calculate depreciation or a depreciation rate, what's the basis of that? Is an estimate, is not with precision. And so when we are talking about the fact that we make estimates and judgments when preparing our information, there's a term for it, which is measurement uncertainty. So measurement uncertainty means that our figures, our estimates, the figures, our measurement is not determined with precision. It is not an exact depiction. So there are certain levels of uncertainty in it. So measurement uncertainty is just recognizing that, yes, our measurements are based on estimates. They are based on judgments. We use models. They are not an exact depiction, right? So, which is why IAS1, when I teach you IAS1, IAS1 requires that every entity, you must disclose the areas where you have measurement uncertainty. And where the level of measurement uncertainty is high, you need to disclose that this area, the level of measurement uncertainty is high. And how would you know that level of measurement uncertainty is high? It is high when your estimates are not backed up with appropriate data, or is not scientifically determined. I mean, you could make estimates and there could be a scientific basis for your estimate. For example, now, when you want to determine the useful life of an asset, don't just say 5 years, 8 years. No. I mean, for every car that is produced, when you check the manual, the manufacturer would have written the lifespan of the engine. That could be a basis. Or maybe you have used a similar asset and that asset used 7 years. That could be a basis. So there should be a basis for your estimate. Don't just make raw estimates and just, no. So it makes the level of measurement uncertainty too high, and it will affect faithful representation. It will affect it. Okay, so that is faithful representation. Of course, they have asked this severally. So faithful representation presents what your underlying transaction represents. Your information must be complete, neutral, and also must be free from errors. Now, there is no way that you can faithfully represent if you don't present your transactions in accordance with their economic substance over their legal form. It's not possible. All transactions in reports must be presented in accordance with their economic substance over their legal form. And that takes me to substance over form. It is a backbone of faithful representation. It is not a separate qualitative or fundamental characteristic. So it is implied in faithful representation, because faithful representation of a transaction is only possible if accounted for in accordance to its substance and economic reality. So how can you then present transaction in accordance with its economic substance over legal form? So let me use an example to deal with that. An example, let me take assets. So you have an asset and you want to report that asset in your books. You see, for us accountants, our focus when putting that asset in your books is not who owns the assets. It is not our primary focus. We are not tax people, right? Our focus is who is using these assets, who is making money from these assets. Because accounting is all about economic activity, making money, spending money, transactions. So our focus is who is making money. So if you lease an asset, you lease it, and that asset, you are then using it in your business, you are making money from it, and all of that. IFRS 16 requires that you should recognize that asset in your books, even though it's not your own. Recognize it in your books because you are making money from it. That is economic substance. So we are not concerned about the legal form of a transaction. We are not concerned about contracts. We are concerned about who is making money, who is spending money. Then recognize the asset. The same thing as liability. We don't care about the underlying contract. As far as reporting is concerned, who is going to settle this liability? Who must settle? Then put it in your books. For example, now, when it comes to income, you sold an asset to somebody. You then quickly recognize revenue. But when we looked at it, we saw that this asset you said you sold, or these goods you said you sold, you are still using it. It is still being used by you. We would recognize that revenue from your books because we will say that you did not sell. It will not meet the requirement of IFRS 15. So as far as we are concerned, when you sell and you are still using that item, it's not revenue, because the economic reality, the financial reality is that you are still using it. So you cannot say you have sold it. And in fact, if that person has paid you, you have collected money from that person, that money is going to be a loan in your books. It will be a loan, and you will be recognizing interest on that loan. You see, all of these, I'm just fast forwarding knowledge, right? This is just an introduction. This is background. For me, this is the most important topic in financial reporting. The most important. But a lot of students, they will not read this one. They will ignore it. They will be reading the big standard. I want to read this one. I want to read that one. They will forget the background that will catapult you into the main standard. So that's why I'm taking my time to really explain all of these things. Okay, so as we move on, you'll be seeing that most standards are developed by focusing on economic substance and not legal form. I'm only giving you 2 examples, so more will come as we move on. Jimmy?
Yes, thank you, sir. So, speaking on economic substance and representation of assets, now, as an investor, I'm coming to invest in a company and I'm looking at their assets. Now, if I go by the economic value as you've mentioned, for an asset that is leased to me and is captured, is that not misrepresentation in itself? Because I'll be judging the company that, oh, they have this value in terms of assets, and should the company be winding up, we can also dispose some of these assets to get our capital back. Or is there somewhere in the notes that this substance will be captured to say these particular assets are on lease and not entirely that of the entity? Thank you.
Thank you very much, Jimmy. Fantastic question again from you. So, let me fast forward knowledge a little bit. One is this, the way those figures would be recognized in a book. In fact, the way it will have been described, it will clearly show that this is a leased asset. IFRS 16 calls it right of use asset. Right of use asset. So any user will see that, okay, this is not your own, right? That's one. 2, the figure you would put in the books is usually at an amount of the benefit you will get from using that asset over the period. You would get, this is a fast forward of knowledge, right? I just want to answer your question. So the cost of the asset might be maybe 50 million, but maybe you are just using the asset for 3 years. So there's a way we'll calculate the benefits you will get over 3 years. And then that is what you will put as the value of the asset today. So you will learn that better, but for now, I like the way you're thinking. Continue that way of thinking. You will do so well in this class. So, but for now is that what I just want you to know for now, what I want to communicate to you for now is that in reporting, you will see that when you are putting assets in your books, it doesn't necessarily have to belong to you. Though, I mean, free from error says that don't make error or omission when describing a phenomena. You describe it properly, everybody will see it. That's for assets. For liability, we don't care whether you're the one that went to borrow the money or not. What is important is, are you the one settling? If you are the one settling, then put it as your liability if you are the one settling. How it came about is not, if you are the one settling, put it in your books. For income, before you can put revenue in your books, I mean, you must have met a lot of steps. You need to be sure that that money will actually come into you and all of this. So with that, then you'll be recognizing in accordance with it, with its substance over legal form. In fact, there are some transactions where you would transfer an asset, or you would sell, and you have actually released the product, you are not using it, but there is an option to repurchase. There's an option to repurchase. That one also, I won't want to go into that, but we might not agree that it is revenue, depending on the kind of option that you have to repurchase. If you are the one dictating the price at which you repurchase it, then you did not sell. Okay, so that's that for economic substance over legal form. So all these examples I'm giving you, if you remember one or two, because I kind of asked you to explain economic substance over legal form before, for 2 or I think 3 marks. So you can explain it like transactions are accounted for in accordance with substance over legal form, where it is the party that is enjoying the economic benefit from an asset that recognizes it in his books and not the owner of the asset. And faithful representation of a transaction is only possible if it is accounted for according to its substance and economic reality. Okay, that's the fundamental characteristics. You see, relevance and faithful representation, any information that loses it has lost all. That information is not useful. It's not useful. Okay, going on. Enhancing qualitative characteristics. Remember, this makes it more useful or less useful. So this one is not as important as that fundamental characteristics. It only makes it more useful or less useful. So there are four of them: comparability, verifiability, there's timeliness, and understandability. Okay. So the first one, which is comparability, this simply means that the information should be prepared in a way that we can compare it. It can be compared with similar information about other entities and with similar information about the same entity for other periods, right? So comparable, we should be able to compare it with similar information of other companies. And we should be able to compare it with similar information of your own company of previous period. Okay, you must be able to compare 2004 and 2005. They should be comparable. And how can they be comparable? If there are consistency in treatments of items, consistency, you are treating items the same way year in, year out. Consistency is extremely important in reporting because that's what makes it comparable. And also disclosure of accounting policies. You must disclose accounting policies used. So we will teach you IS-8 on accounting policies, and you will see that the basis of determining figures in the books are backed up by an accounting policy. Every figure in your account will have an accounting policy, every item. So when you tell us what your accounting policy is, then we'll be able to compare, because if the accounting policy for revenue in year one is different from accounting policy for revenue in year two, then that revenue is not comparable. Anyway, it's not even allowed for you to change your policy like that. There has to be consistency of accounting policies. So you need to disclose your accounting policy if you want to achieve comparability. The second enhancing characteristics is verifiability. So we should be able to verify your information, which means that different knowledgeable and independent observers should be able to reach a consensus that your figure is a faithful representation, which means that if you put your figure in the books, for example, you said you have a motor vehicle and you said the value is 100,000, you put it there in your books. An independent or a knowledgeable user should be able to recheck or recalculate that figure and get something similar. That's when it's verifiable. And how can you achieve that? It means you must provide appropriate breakdown. In the same information, there should be somewhere where you will have given us, okay, what was the actual cost? What was the useful life? What was the depreciation rate? With those information in place and further disclosures, we would be able to recheck and recalculate. That's being verifiable. I mean, they should be able to come to a consensus with you that, okay, this guy has actually gotten a right figure. If we cannot recheck and recalculate, then it is not verifiable. Okay, so it makes it more useful. Another one is timeliness. So the information should be available to decision makers when they need it, when they want to use it to make decision, especially your investors, your lenders, your other creditors. Give it to them when they need it. Otherwise, it will be less useful, especially companies like banks, right? Where they need to file their annual account to CBN, there is a regulatory deadline. If your audited account is not ready as at that date, you will have problem with those regulators. And there are a lot of regulations or regulators that have deadlines. If you want to file your returns with FIRS and your account is not ready before the regulatory deadline, it's a problem also. So timeliness is key in reporting. So make it ready on time when users need to make decision. Then we have understandability. So users should be, the report should be easy and concise for users to understand. And financial reports are actually prepared for users who have a reasonable knowledge of business and economic activities and who review and analyze the information diligently. So when we say that the information should be understandable, so here we are not talking about all users. We are not talking about maybe a particular person. We are talking about someone that have reasonable knowledge of business and economic activity. We are talking about accountants. We are talking about professionals that are ready to review the information and analyze it diligently. So that's the user we are talking about, because you guys are here to learn about reporting. Okay, so it's you we are talking about, somebody that is knowledgeable about accounts, about business, about economic activities. Then if that kind of person picks your report and does not understand it, then there's a problem, right? That's understandability. It should be easy for users to understand, users that have reasonable business and accounting knowledge. And there is cost constraints. Okay, that one is a separate term under chapter 2, which is just saying that when you are providing your information, when you are complying with all these qualitative characteristics, make sure that the information need or the benefits actually justify the costs. So if you are a sole proprietorship business and you want to meet all of these qualitative characteristics, you will spend so much money. And since you are the sole owner of the business, so you don't really have to do all of these things that we are talking about. It's not for you. It's for, they're actually for companies that have investors, that have creditors, that have lenders. Those are the kind of people we are actually referring to, not a sole proprietorship business. So for those ones now, the benefit of preparing this information would definitely outweigh the cost. Okay, that's the chapter 2 of the conceptual framework. Any question? Chapter 2 is the longest part of it all. Yeah,
Hello.
please go ahead.
Yeah, please. I'm still struggling to understand the substance over form.
Okay, so if you are still struggling, what we should do is that why don't you focus on lease alone? Okay, focus on lease alone for now. That when you lease an asset, even though the asset is not your own, right, you can still put it in a book. Logically, one will say that, like I think Jimmy asked the other time, that this asset is not your own, you are putting it. You mislead people now. So logically, one will say that this asset is not your own, then don't put it in your books logically. However, because you want to comply with economic substance, because you are making money from these assets, then you have to put it in your books. That is economic substance, because that's the reality, that's the financial reality as far as we are concerned. You are making money from this asset. You have control over these assets. That's the economic substance for us. Okay, so we don't focus on legal, that who owns the assets, not the legal form. Our focus is, are you making money from the assets? If the answer is yes, then put it in your books as an asset. So if you can focus on that, at least you understand something for now. Then as we advance, then others will come naturally for you, and that will help you.
Thank you.
You're welcome. So I need more people that don't understand. I will say I don't understand.
Hello, sir.
Yeah, yes.
I just want to ask a question on, you said using accrual basis. Let's say, for example, we want to recognize our income in the financial statements. And
Yeah.
then when a person purchases goods, and then like you said, accrual basis, we report when it is earned and not when cash is paid. And
Yes.
then we now record that particular sales in our income. Then by the end of the year, when when we want to close the account and the person has not paid, that kind of transaction, do we now debit our income and then go to how do we do it are we going to take it to receivables, or how is it going to be represented?
Oh, fantastic, fantastic. So again, when we say earned means that you have provided the service. That's when you have earned an income. You have provided the service. So even if the person does not pay, is your revenue, you earned it. You earned it. So one leg will be in revenue. The other leg, there will be somewhere showing that, okay, this person is owing you. We call it receivables, trade receivables, right? So it will be there. So if the person does not now pay for an elongated period of time, then that means you then have to now take it from revenue, from receivables. If the person does not pay, that's what we call bad debt. In fact, before it gets to that point, prudence will say that you should have made an allowance for that bad debt. We call it allowance for impairment. It will tell you, but nothing is going to touch your revenue. Your revenue would continue to represent revenue because you have earned it. Okay, but the guy did not pay is a different thing. So you earned it when you have done the work. So it will be there that you actually performed an economic activity. It's there. So by the time you are now expensing that receivables, it's of course going to net off that revenue ultimately, but at least you are not offsetting. You are presenting them separately. Revenue that I've earned, but somebody did not pay, then now under my expense is coming as bad debt. So they will clear out eventually. But I mean, the focus of today is that accrual means that you have earned it. When you earn it, recognize it as revenue in your books. I hope that helps.
Thank you, sir.
You're welcome. More people, more people, more people. I'm enjoying this online class. If it's physical, they will not ask questions. More questions? Jimmy? Okay. Let's go to chapter 3 then. Financial statements and the
No
reporting
question, sir.
entity. Oh, okay, Juliet. Oh, yeah. Ask question, please.
No, I said no question, sir.
Oh, okay. All right. So let's go to chapter 3, which talks about financial statement and the reporting entity. So this one really focuses on the objective and scope of financial statements, which we have already discussed in chapter 1. It's the same thing, to provide information about asset liabilities that is useful to users. And the only thing is that this provision of information is management stewardship of entities' resources, just showing that, okay, this is what we have used the money you gave us to do. So that's not the focus here, because this has been settled in chapter 1. However, the new thing here is reporting entity. And when we talk about reporting entity, we're talking about an entity that is required or or chooses to prepare financial statements, right? So there are some entities that are required either by their regulator or by their country or by a regulation that they have to prepare. Why some does choose to, like a sole proprietorship business now, there is no requirement that says it must, but they can choose to, right, to prepare. And furthermore, a reporting entity can be a single entity, meaning an entity on its own, like GT Bank PLC now is a single entity, Networth Limited is a single entity, Equity Limited is a single entity. Any company on its own, or any sole proprietorship business on its own, or any partnership business on its own is a single entity. And a reporting entity can also be a portion of a single entity. Like some companies would have branches, they have segments. These are portion of an entity. Okay, those are portion of one entity, can have several branches all over. So that's a portion. So that means that you can prepare accounts for that portion alone because it's a reporting entity. And a reporting entity can comprise of more than one entity. These are particularly entities that have subsidiaries. Okay, so together they are a reporting entity, right? Because as you will learn very soon, how to prepare accounts for group of entities. And a reporting entity does not necessarily have to be a legal entity. It doesn't have to be legal. So a reporting entity can be either a sole proprietorship business, it could be a partnership business, it could be a company. So here, it's just emphasizing the fact that don't see a reporting entity as a company. No. A reporting entity is any form of business. Any form. So everything we are learning in IFRS can in fact be applied by any form of business, which is the focus of what we want you to know here. Then reporting period, this looks at the period over which the period over which the financial statement is being prepared. Usually that's the current period, right? When we say reporting period, just current period. And also it could provide comparative information, which is the previous period. So reporting period, as far as this conceptual framework is concerned, it could be current and previous, right? So, and with those information, we can have predictive value, forward-looking information, okay? Forward-looking information. But reporting period is current and previous period. Then this wants to just make sure that you understand what we have been talking about in chapter 2, which is perspective adopted in financial statements. So this is just saying when you are providing your financial information, the transactions you put there should be about the reporting entity, not the investors. Don't be biased. Don't manipulate the information. That's what this one is talking about. So the perspective of the information you present to users should be from the perspective of the reporting entity. So this is just emphasizing that specifically and clearly. Okay. Then going concern assumption. So going concern assumption is that when you're presenting your financial information, it should be presented on the assumption that the entity will continue to operate into the foreseeable future. It should be prepared on the assumption that the entity will continue to operate into the foreseeable future and is not going to discontinue or shut down. That's the assumption. That's the general assumption here. Finally, under chapter 3, talks about consolidated and unconsolidated financial statements. So entities that have subsidiaries should, it's better for them to present consolidated information. Okay. because it's more useful to users than unconsolidated. These for entities that have subsidiaries. So that's chapter 3. So I kind of really never touched on chapter 3. Most questions they have asked so far in the past has always been chapter 2, because those are the key areas. Not that all of other ones are not key, but it's always interesting to ask questions from that angle. Now, chapter 4 talks about the elements of financial statement. And there are 5 elements. There is assets, there is liabilities, there is equity, there is income, and there is expenses. This is what we want to teach you in the whole of financial reporting. Everything we are going to be talking about is around these elements. Everything. Everything has a link to these 5. So this chapter 4 just looks at the definition majorly, and an asset here is a present economic resource controlled by the entity as a result of past events. And an economic resource is a right that has the potential to produce economic benefits. So when we say an asset, it said a present economic resource. So when we say present, it means that the transaction must have occurred. What gave rise to that asset must have actually, it must be present. You don't say you have an intention to buy an asset. That one, don't even go there. You have an intention. That one cannot be an asset. It must be present. Transaction must have occurred. And economic resource. So an asset is an economic resource. So what is an economic resource? It says here that an economic resource is a right that has the potential to produce economic benefits. An economic resource is a right that has the potential to produce economic benefit. So what this is saying here is this: anything that produces economic benefit to you, that thing is an economic resource. So, of course, you must have a right over it. And right in the sense that it doesn't have to be something you see. It doesn't have to be something physical. Anything, just think about, is this thing making money for me? It is an economic resource. And it might not necessarily be bringing in money. It could be savings. Okay? It could be maybe reduction of your liabilities. It could be anything that produces benefits to you. So these benefits could be in a variety of ways, but the clear one, I mean, for simplicity, is either is making money for you or is making savings for you. Then that is an economic resource. There are a lot of them that you can think about. A lot of us our mind will narrow down to maybe land and building, furniture and fittings, motor vehicle, like we know. But an asset is beyond all of that. An asset is beyond all of that. Anything where you have an expectation, like if you pay rent now for 1 year, you pay rent for 1 year, you paid 1 million. A good accountant will not recognize the whole of that 1 million as an asset when you are preparing your report. Sorry, as an expense. That okay, rent. A good accountant would only recognize a portion of that rent depending on when you are preparing the report. If you are preparing a 1-month report, you only put a portion of rent relating to 1 month in your books as expense. Why the remaining one that you have not used, that you are going to get benefit from in the future, you put that one as an asset? That's what we call prepayment. Okay, so I mean, that's what an asset is, something that will produce economic benefit to you. However, when there is a present economic resource, before you can recognize it in your books, you must have control over that economic resource. And control here means that the money being made from this economic resource comes to you, close to the entity. Then you have control. and as a result of past events. So, I mean, this further buttress my point on economic substance when I was talking about assets, right? So, is a present economic resource controlled by an entity. So, it's not something you have bought or acquired. No, that's not what an asset is. An asset is a present economic resource, something that makes money to you, and you have control. Control here means that the flow of that economic benefit comes to you. Economic resource controlled by the entity as a result of past events. Liability is a present obligation of the entity to transfer economic resource as a result of past events. Of course, it must be present. The transaction must have occurred, and it must be an obligation. Obligation is your duty or responsibility to act in a certain manner. Your duty or your responsibility to act in a certain manner. You see, that duty or responsibility to act in a certain manner becomes an obligation here. If you have no practical ability to avoid that action that you must take, you have no practical ability to avoid it, meaning you must do it. If it's payment you have to make, you must pay it. If it is, maybe you're supposed to deliver some goods, you must do it. That if you don't do it, you know you'll be in trouble. Then that is an obligation here. That's the kind of obligation we are talking about. The one that you have no practical ability to avoid. Okay? And the focus here is that this action is to transfer economic resource as a result of past events. So anything where you have to transfer your resources to a third party, then you have a liability. Then the next one is equity. So equity is the residual interest in the asset of an entity after deducting all its liabilities. So residual interest in the assets. So when we even say interest in an asset, who are the people that have interest in an asset? There are two people, right? There are first, there are people that the money you make from that asset, they are the one that collect it. Those are the people that have interest in the asset, that the money that is made, the people that collect that money is those that have interest, and is either the owner of that asset, right? Or the person that has control, or the person using it, who is equity. And number two is the people that you are owing money, right? Those are the people that have interest in an asset. So the ones whose interest is now residual in the sense that the money made from that asset is the remaining you give to that person, is the residual you give to that person, then that kind of person is called equity. And an example is ordinary share capital. Those are equity because they are the ones that have residual interest in the asset. Of course, after deducting liabilities, right? Liabilities also have interest in the asset, but their own is preferential. So the ones that are residual are the ordinary share capital, and we call them equity, holders of equity claim. Then income. Income is an increase in assets or decrease in liabilities that results in increases in equity other than those relating to contributions from holders of equity claims. So income is an increase in assets. For whatever reason, if your assets increase, that increment is an income. if your liability decreases, that decrement is an income. And it will result in an increase in equity. So when your equity increases also, it's also an income. But there are two major items that increases your equity. Don't forget, I told you that equity is ordinary share capital. Of course, if you asked those share capital to contribute more capital, your equity will increase. That additional capital, that one is not income, which is the basis of this next sentence here that says, other than those relating to contributions from holders of equity claim. We are not talking about contributions from shareholders. We are not talking about additional capital here. So they need to make that exception so that you will understand that that one is not income. Then what income are we talking about? When we talk about increase in equity, we are talking about profits. Profit. And that's the income we are talking about here. Finally is expenses. Expense decreases in assets, increases in liabilities that result in decreases in equity other than those relating to distributions to holders of equity claim. So again, when your assets decrease is an expense, when your liability increase is an expense that results in decrease in equity. So again, two things majorly can decrease your equity. There could be other ones. Number one is dividend. When you pay dividend, it decreases your equity. Dividend is not an expense. You never find it in an expense. Dividend is when you have made profits, then you pay it from your profits. So it decreases your equity. So that's why they are saying that this decrease in equity here is other than those relating to distributions to holders of equity claim. So we are not talking about dividend here. So if we are not talking about dividend, then what decrease in equity are we talking about here? We are talking about losses. Losses is what we are talking about here. So those are expenses. So those are the elements. All these explanations I'm giving, actually, I've already broken it down for you in your notes. So that's chapter 4 on elements. Then chapter 5 on elements. Before I move to chapter 5, this note I'm presenting, I have the one I shared with you is more updated. I want to ask you a few questions, or let me just finish all my explanations, then we can look at the questions together. Chapter 5 talks about recognition and derecognition. First one is recognition. So recognition is a fancy way of saying recording, right? So recording or recognition is the process of capturing for inclusion in the statement of financial position, the statement of profit or loss, and OCI, an item that meets the definition of one of the elements of financial statements, whether assets, liability, equity, income, or expenses. So that is recognition. You recognize if the item meets the definition of one of the elements, like those definitions we just mentioned earlier. He now went further here and said that an asset or liability should be recognized if it will be both relevant and provide users of financial statements with a faithful representation of the transaction. So this is further saying that you can recognize an asset or liability if it meets the fundamental characteristics. That is relevant, if that item will be relevant, and faithful representation. So ICANN can ask you in the exam that explain recognition and describe the recognition criteria in the conceptual framework. So recognition is the process of capturing for inclusion in the statements And there are two recognition criteria I've mentioned here. Number one is an item, you recognize an item if it meets the definition of one of the elements of financial statements: asset, liability, equity, income, and expenses. That's one. Number two, if the asset or liability will be relevant and provide users of financial information with a faithful representation of the transaction. That's two. And when they were talking about this one, they only focused on asset or liability. Abi, won't you recognize income, expenses, and those other ones? Of course you will. So the reason why they focus on assets is that they know that it's assets. When you have assets, that's what generates your income. You will definitely have an income when you have assets. When you have liability, that's what would definitely generate your expenses when you have liabilities. And assets minus liability is what gives you equity. Is what gives you equity, which is why they just assets or liability, because these two creates the other ones. So that's recognition. Then derecognition. So derecognition is the removal of all or part of a recognized asset or liability from an entity's statement of financial position. So derecognition occurs when that item no longer meets the definition of assets or liability. Then derecognize. So derecognition is just the opposite of recognition, is removal, right? So they can ask you, what are the derecognition criteria? So if you say this, okay, you derecognize an item when the item no longer meets the definition of an asset or liability. You can say that a reasonable examiner will give you your mark, or you can break it down. That's number one, where there is loss of control of all or part of a recognized asset. You know, when you lose control of an asset, which means that the money you are making from that asset is not flowing to you anymore. It doesn't meet the definition again because control is lost. Or when the entity no longer has an obligation for a liability. When there is no obligation, like maybe you can avoid that your duty to act in a certain manner. That means there is no obligation. That means it doesn't meet that definition again. You have to derecognize it from the books. That is recognition and derecognition. So I can, as asked this particular one before, talking about derecognition and recognition criteria. So this is very highly examinable. What I can even ask is definitions of these items. I mean, of course, you need to understand this. This is what we'll be talking about all through the diet. So you need to know this definition by heart. When I finish my class, I will show you some questions I will use as quiz. So chapter 6, which talks about measurements. So give me 1 minute. Just give me 1 minute. I'll be back. I'm back. So speaking about chapter 6, that talks about measurement. So the elements recognized in the financial statement are quantified in monetary terms. So quantification of these elements in monetary terms is what we call measurements, the figures, right? And so this requires selection of measurement bases. So there are actually two measurement bases in reporting, in financial reporting. There are two measurement bases. One is historical cost. Two is current value. So historical cost is the price paid for an asset or for the events which give rise to the liability, and the price will not change. Historical cost does not change. For example, if you buy an asset in 2010 and you put it in your books at 2 million, you bought it at 2010 at 2 million, You see, if your measurement basis is historical cost, and you are still using the assets you now, it's still going to be at 2 million. The price will not change. So it's the price you paid for an asset or the event that gave rise to liability. The price does not change. It will not change. It will just be at that amount. And we still use that up to today. So, I mean, you can easily see the practical disadvantages of that. It will make your figures irrelevant. You cannot use it to make decisions. You cannot use it to make predictions, right? You cannot even use it for confirmation because it's just there, it's not changing. Then the latest one is current value, which is also the same thing as historical cost, except that this one will change. That's the only difference. So it's also the price paid for an asset or a liability that will be updated to reflect any changes since it was acquired or incurred. So these ones are usually updated. This one will show what's the current price. It will show the most recent figures. So when we talk about current value, there are three main bases that make up current value. Okay, there are three items that make up current value. So current value itself is not the value we will use, but one of these three is what we will use. Either we are using fair value, value in use, or current costs. So for fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This definition is not our focus today, but rather our focus is how do you determine fair value itself? So fair value is just, if I want to sell this asset today, how much will I sell it? That's fair value. It's similar to your revaluation amount or revalued amount. If I want to sell this asset today, how much? So you can use that as some of the values you will use in your books, and you are going to meet it in several places as we continue to move on in our studies. When we look at IAS 16, we'll meet it there. IAS 38, we'll meet it there. IAS 40, we'll meet in most of these standard on assets. We will be talking about fair value in those standards. Okay, Jimmy.
Yes, thank you, sir. Please, is fair value the same as forced sale value?
No, it's not the same.
Okay, thank you.
Yeah. Okay. So again, the one we are going to meet this fair value in several places because it's now mostly used right now. We are trying to move away from historical costs to current value, and fair value is one of the forerunner or front runner when it comes to measurement basis. Another one is value in use. Okay, so for this one, we are saying that if I continue to use these assets for the next 5 or 10 years or for its entire useful life, how much benefit will I get in total? So value in use is the present value of the cash flows or other economic benefit that an entity expects to derive from the use of an asset and even its ultimate disposal. So value in use, we are going to meet it only in IS 36. So it's not something that's very popular. It's very sparsely used. It's only going to be used when we want to determine recoverable amount. But the idea of value in use is that, okay, what is the value of this asset from the standpoint of value creation? that if I continue to use this asset for its useful life, what is the entire benefit I will get? If it's 5 years, what's the benefit I will, including if I sell it at that future date, everything. So, however, that's actually speaking to future values. And in reporting, we don't recognize future value. Anytime we talk about anything about future, we need to discount it to present value. So by the time you now get the present value of all those future benefits, then what you get is value in use. Okay, so the class today is just for you to have an idea that, okay, it's a call, right? It's the value you will get over the life of this assets, including if you eventually sell it. Everything is value in use, and of course, it's the present value of those future benefits you would get from using this asset. We're only going to meet it in IS 36, only in IS 36. So when we get there, we would concentrate on that. And the final one here is current cost. So current cost is very similar is actually similar to fair value. It's very similar to fair value. The only difference is that while fair value focuses on what I will receive if I sell, this current cost will focus on what I will pay if I want to replace this asset. So current cost is more like a replacement cost. Both of them are looking at the price today, but one fair value is looking at, okay, if I want to sell, how much will I collect? Current cost is looking at, if I want to buy this similar asset, how much will I pay? That's the current cost, right? So again, current cost too is not so popular. We won't even see it anywhere in all of our studies. So you probably see historical costs a lot of times. We'll see fair value in a lot of places, and we'll also see value in use only once. But at least this is the guide, this is the conceptual framework. Okay, Oluwaseun,
Okay,
please go ahead.
so yeah, quick one. Does fair value, does it changes? Just just like you said, the historical costs is constant. Does
Yes, all of
value in
these,
use, so value in use, sorry. Value
yes,
in
it
use.
does. Yes, it does. So all of these, you know that all of these three they are all current value.
Yeah.
So yes, and they all change. They are updated. So the current value this year will not be current value next year. So fair value, it changes every year. Value in use, it changes every year. Current cost, it changes every year.
I want to know how value in use will change since we are considering the future value at every point in time, addition of the future value and the value, like all the value you can derive from that item. Then I want to know how it will change, maybe by this time next year.
Okay, just to answer your question, that is not our focus for today. Just to answer your question, if today now I'm supposed to use the asset for the next 5 years, and I estimate that, okay, every year I'll be generating 13,000 every year. So by the time you do the discounting of those 13,000 for 5 years, you get value in use today. Next year, is it going to be 5 years again? Shall answer. Will it be 5 years again if I want to estimate current value? It will be
I
4
lost
years
it.
now. It will now be 4 years. Abi?
I said I lost it.
Oh, you did not hear me? Hello? Hello, Shane, can you hear me?
Yeah, I lost it when you said that it was not the focus. So I was thinking you will know it.
Oh, okay. So again, I was saying that if you want to get value in use today now, and you want to use the asset for 5 years, okay, and let's assume that you are going to be making 10,000 naira from that asset every year. So the way you determine value in use is you discount it to present value. That gives you all those 10,000 for the next 5 years. That gives you your value in use. Okay.
Excluding what
Next,
has happened before. Okay, thank you. We're just from present onward. Thanks.
yeah, exactly, yes. Okay, so I've actually, all these I've explaining, there are further details here. So that's chapter 6. So for the chapter 7, this talks about presentation and disclosure. So there's not so much here. So what this chapter is really talking about is that all these items that you have recognized, you have to present them. And more importantly, disclose further details about them. So it talks about certain principles of presentation, which we are still going to look at as we move on. So saying that, okay, ensuring that you classify your assets and your liability properly. Assets that are similar, you can put those ones together. The ones that are not similar, you should try to separate them. And don't offset items. We're still going to talk about all of these things, right? So classification of assets and liabilities, it talks about avoid unnecessary details in your information, avoid the standardized approach. You need to tailor your information to your company. So these are principles of presenting and disclosures that they gave us. But more importantly for this chapter 7, is that income and expenses, okay, that arise from entities' key operations should be presented in the statement of profit or loss. All income and expenses presented in P&L. And there's another statement called other comprehensive income. These ones, income and expenses arising from change in current value of an asset or liability, is what goes to OCI. Income and expenses arising from change in current value. The only one I will teach you in this class, in your syllabus, is revaluation surplus. That's the only one in your F-file syllabus that we're going to touch on, revaluation surplus. I might just touch on change in foreign changes in foreign currency by chance. Maybe, I doubt it. But the one we'll really talk on is revaluation surplus. Revaluation surplus is an income that arises from changes in value of an asset. It doesn't go to P&L. It goes to OCI because it is deemed to be unrealized. Because it's just a change in the value of an asset. You call the valuer, your asset in your books was 10 naira. The valuer said, the value of this asset is now 15 naira. So in accounting, we would book a gain of 5 naira. That 5 naira, you cannot go and put it in P&L because it is unrealized. They don't want users to be making decision on a valuation gain. No. So put those kind of items separately in your P&L. However, if they then become realized, like for example now, that asset I said they revalued, if you now sell that asset and you're able to sell it at that big value, that gain has become realized. Then at that point, you can then transfer it from OCI. You can transfer it to either P&L or directly to retained earnings. Specifically, revaluation surplus doesn't get recycled. We call it recycled. Doesn't get recycled to P or L. No, it's transferred directly to retained earnings. So all of these will become clear when we do IS 16, especially for these examples I've just given you now. But summarily, that's what this chapter 7 is actually talking about. Then chapter 8 is talking about the concept of capital and capital maintenance. You already know what capital is, which is equity that we talked about in chapter 4. So what is the concept of capital? So I'll start from here. There are two concepts of capital. There is the financial concept of capital, and there is the physical concept of capital. The financial concept of capital is the concept that we use when preparing financial statements. That's what we use as of today. And under this concept, we see capital as invested money. Okay, usually we will see it as invested purchasing power, and capital is synonymous to like net asset or equity. Like I told you, the way we get capital as that the way we present our books now is just your asset minus your liability is your capital. So the way we present capital is actually very straightforward right now. That's what we use. But there is another way we can present capital, which is the physical concept of capital. This we don't use it, but it's allowed. But I bet you no one will use it. Look at it. There are a lot of controversies around it. So this physical concept of capital sees capital as the entity's productive capacity or operational capability. Okay, an example is unit of output per day. So physical concept of capital sees capital as what can you produce in a day? What value can you create? Your productive capacity. Those are the two concepts of capital. For you to appreciate the impact of the difference, then that's what concepts, this capital maintenance, that's where it comes in, so that you appreciate those two concepts of capital. And when we say capital maintenance, see, an entity has maintained its capital if it makes profits. An entity has maintained its capital if it makes profit. And in determining profits, how do you measure profits? Okay, because of course, you know your profit is income minus expenses, but it's different. For financial concept of capital, I will call determining profit there, I will call it financial capital. Let me go here. I will call that financial capital maintenance. While for physical concept of capital, I will call that physical capital maintenance. So for financial capital maintenance, you have maintained your capital when you make profits, okay? So what we use today, we see profits as the increase in nominal money capital over the period. So which simply means that if at the beginning of the year, my capital was 15 naira, and at the end of the year, my capital is now 17 naira, my nominal money capital has increased. So I've made profit. That's profit. So that's why when you prepare your P&L and you get profit, they usually go transfer that profit to equity, just so that it will increase your capital, right? So this is what we do today. So it's quite straightforward. When you have maintained your capital when you make profits. So, but financial capital maintenance is just when your profits represent increase in your capital, in your nominal money capital over 1 year or over the period in view. For physical, don't forget, physical, that one looks at unit of output, your productive capacity. So there, you have made profits or maintained your capital if there is an increase in that productive capacity over that period. If there is an increase in productive capacity over that period, then we can say that, okay, you have actually made profit. Now, how do we then understand this impact finally? I mean, you have seen it theoretically. Let me use this figure here. So let's look at this company. They gave me figures at the beginning and at the end, okay? This company has an inventory. They have 100 units. At the beginning of the year, the value of these 100 units is 500 naira, which means that each unit will have cost 5 naira. So let's assume that during the year, they did not do anything. They did not sell, they did not buy. Nothing happened. So what will have made this inventory to go up? Inflation. Maybe now the costs, the replacement cost is now 6 naira. That's the really reason why this thing will become 600 naira, where our units still remains constant at 100. So I'm just trying to explain physical financial that, okay, let's look at a static company that did not do anything for a year. 100 unit inventory, at the beginning, value 500. At the end, just because prices went up, in accountant will record an increase, which is 600 naira. Other assets remains the same, on 1,000. Those ones did not change. And don't forget, your capital is your asset minus liabilities. Now, when we don't have liabilities, then that means 500 plus 1,000 gives me my capital. 600 plus 1,000 gives me my capital of 1,600. You see, if an accountant picks it, like you guys now, from what I've told you, my nominal capital has increased from 15 to 16. So accountants, we will say we have made profits. We will recognize a profit of 100 naira because my capital at the beginning 15, my capital at the end is 16. Whereas this 100 naira is just holding gain, it's just inflationary profit. It's not profit that somebody should be proud of. It's not somebody that somebody should be proud of. So, but for physical will focus more on the outputs. That's your productive capacity hasn't changed. This your 500 naira could do you 100 units at the beginning. This your 600 naira can still only do you 100. So you have not made profit. And that's the problem today. And that's why there was a CBN circular that stopped banks from distributing, that they should not put foreign exchange gain in their P&L, that they should not add it as part, they should separate it. Because they have foreign banks have most of them have very healthy net foreign positions, right? Where they have huge foreign currency balances. And, within the space of few months, the exchange rate depreciated by almost 200% or more, from 400 and something naira. Right now, it is 1,550 naira as of yesterday, or 1,560 naira. So somebody that is holding foreign currency in dollars, for example, now, if you translate it to naira, it becomes bigger between the period when it was 450 naira to a dollar, and now that it is now over 1,000 naira. So you will have made huge gain. So banks were declaring huge profits. CBN won them. Yeah, fine profits, but remove this your foreign exchange gain. It is not a profit from economic activity. It's something you should keep somewhere so that in case this thing reverse, you would still maintain your position. And that is another reason. Another one is the CBN came and said that all banks must recapitalize. One of the reasons is really because of most of these banks is because of inflation and also the foreign exchange rates. Okay, for them to sustain their physical productive capacity, they will need to inject more capital, and which is why CBN, they are actually bringing out a lot of policies, at least for banks, For other businesses, even though we don't use physical capital concept, we need to have it at the back of your mind that can we actually maintain our productive capacity? Okay, so that is the concept of capital and capital maintenance. So here I've collated some questions. There are past questions that I can have asked in the past. The ones that are not ICANN past questions, I already put the solutions there for you. It's already, this handout, you already have it. So you will see there are a lot of questions there that I've put. Okay, so we would stop the class for today. Then we would see those my physical class students. We'll see you guys next week on Saturday, while my virtual class students will be meeting during the week to start a new topic. So thank you very much. Bye-bye.